All right, let's dive in. Today, we're going to demystify one of the most explosive and transformative moments in a company's life, the initial public offering, or IPO. We're going to break down how a company makes that incredible leap from a private venture into a publicly traded giant.
So, to get us started, here's a question for you. What on earth could a 17th century trading company possibly have in common with two of the biggest tech titans of our time? It seems totally random, I know, but they all share one crucial piece of financial DNA.
And there it is. They all went public. Actually, fun fact, the Dutch East India Company is often credited with conducting the world's first modern IPO, way back in the 1600s. It's a process that has been shaping our economy for centuries. Okay, so what does going public actually mean? Before we can get into the nitty-gritty of how it's done, we really need to understand the what. Because, let me tell you, it is a massive, fundamental shift in a company's entire identity. An IPO, or initial public offering, is pretty much what it sounds like. It is the very first time a company takes its stock, its little pieces of ownership, and sells them to the general public. This is the moment a private company basically swings open its doors and invites the entire world to become a part owner. And this really gets at the core trade-off. See, private companies, they operate in this small, kind of secretive circle of owners. You've got your founders, maybe some family, a few early investors. But the second you go public, it's a whole new ballgame. Ownership is suddenly spread across potentially millions of shareholders, you have to report your finances every quarter, and your stock is out there, trading on an exchange for all to see. So why on earth would you go through all this trouble? Well, the number one reason is money. And we're not talking about a little bit of cash. We're talking about a massive injection of capital to fuel growth, build new factories, or maybe acquire your competitors. And of course, it's a huge payday. It's the exit strategy for founders and early investors to finally cash in on all those years of hard work. Okay, so now we know the what and the why. Let's get into the how. The journey to an IPO, it can take anywhere from 6 months to well over a year. It's an incredibly complex process, but we can break it down into a pretty clear playbook. And the very first step in that playbook, you got to choose your guide. For an IPO, your guide is an investment bank, sometimes called an underwriter. These are the experts who manage the entire chaotic process, from all the paperwork to setting the price. Think of them as the Sherpas for this gigantic financial mountain climb.
The whole journey, according to the Corporate Finance Institute, really follows 5 key steps. You start by picking a bank, then comes a super deep dive into the company's books. From there, it's all about setting a price, supporting the stock right after the launch, and then finally letting it go into the wild of the open market. Let's start with all that paperwork. Step 2, due diligence, involves an absolute mountain of paperwork. And right at the center of it all is a critical document filed with the Securities and Exchange Commission, the SEC, called DS-1. This thing is basically the company's entire life story told through numbers and legal jargon. It contains what's called a prospectus, which is the official sales pitch for investors, telling them everything from financials to all the things that could go wrong. Now, once that initial paperwork is filed, the company's leadership team hits the road. This is the roadshow, a super high-stakes marketing tour where executives and their bankers fly around the world pitching their company to the big-money players, like hedge funds and pension funds. The whole goal is to build hype and figure out just how much demand there is for their stock. Inside the industry, these high-pressure presentations have a nickname, dog and pony shows. It sounds a little cynical, but it perfectly captures the performance aspect of it all. It's about putting on the absolute best show you can to convince investors to buy in. All that information they gather during the roadshow is absolutely crucial. The underwriters take all that feedback, how much interest there was, how many shares investors want, and they use it to determine the final offering price for the stock, usually on the night right before the IPO. And let me tell you, pricing an IPO is like walking a tightrope. If you underprice it, you get that famous first-day pop where the stock soars. Investors love it, but the company left millions on the table. Think of the Globe.com, which went up 1,000% on day one. But if you overprice it, the stock can sink, which just kills confidence right out of the gate, which is exactly what happened with Facebook's rocky debut. So, the company has made its debut. The bell has been rung. But that is not the end of the story. Not even close. Going public isn't a one-time thing. It is a permanent transformation. And that brings us to the long-term reality, what we might call the price of fame.
And the trade-offs here are immense. I mean, on the one hand, you get access to these huge pools of capital, you get public prestige, but the costs are just as significant. IPOs are insanely expensive, founders lose that absolute control they once had, and suddenly you're living under the constant, relentless pressure of hitting your numbers every single quarter.
And let's talk about those costs for a second. The very first bill to come due is a big one, and it goes straight to those investment banks that guided you through the whole process.
7%. That's the typical fee, known as the gross spread. Just think about that. If a company raises $1 billion in its IPO, a staggering $70 million of that can go straight into the pockets of the underwriters. It is one of the most lucrative gigs on all of Wall Street.
And the costs don't stop there. Oh no. Life as a public company means constant compliance with super strict SEC regulations, expensive quarterly audits, and a whole new vulnerability to getting sued by your shareholders. You are always being watched by regulators, by investors, and by the media.
And yet, despite all this, companies still line up for their shot at the big leagues. And the scale of these deals can be just mind-boggling. Topping the list is Saudi Aramco, which raised over $29 billion. Alibaba brought in $25 billion. These aren't just corporate milestones. These are major global financial events.
Which really brings us to our final thought. The IPO is an incredibly powerful tool. It can create unbelievable wealth and fuel game-changing innovation. But it comes at a very steep price, a loss of control, a loss of privacy, and a whole new set of relentless pressures. So for the ambitious founders of the next great company, the ultimate question will always remain, is the price of fame always worth paying?